Hi everyone, I'm Chris Tipper, Chief Economist and Strategist for the Ainslie Group, and welcome to Ainslie Insights for another week, starting with our precious metals update. This week we're covering the latest in gold, silver, and platinum, with highlights like gold's ongoing bull run supported by central bank demand and Fed rate cut expectations, as well as silver's supply deficits driving industrial opportunities amid price volatility from US data, and platinum's intensifying crunch fueled by US and China imports alongside green energy growth. As always, this presentation is brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Be sure to have a look. Let's get started with gold. Gold prices are consolidating around 3,400 US dollars per ounce, showing sideways movement after failing to break 3,500 US dollars, but the long-term upward trend since 2017 remains intact, with potential for a breakout to 3,800 US if resistance clears. Corrections at this point in the cycle should be viewed as buying opportunities, driven by expected Fed rate cuts of 50 basis points later this year, easing trade tensions, and sustained central bank purchases, despite some slowdowns. China's official gold reserves rose by 2 tonnes in July, marking the ninth consecutive monthly increase to 2,300 tonnes, though imports fell 62% year on year in the first half amid weak wholesale demand, offset by surging investment interest. JP Morgan highlights gold's unassailable investment case as a hedge against inflation and asset bubbles, raising their 12-month target above 4,000 US dollars per ounce, bolstered by geopolitics, emerging market central bank demand, and resilient jewellery and tech sectors. Globally, central banks added over 1,000 tonnes annually from 2023 to 2025, outpacing mine production and supporting prices for the 30% gain we've experienced since 2023, amid de-dollarization risks, tariff uncertainty, and dollar volatility. A unique takeaway is that gold's high correlation to economic policy uncertainty and negative ties to the US dollar positions it as a strategic anchor in a multipolar monetary system, with investors being increasingly advised to allocate between 5 and 10% for stability. Overall, gold blends consolidation with strong fundamental drivers like central bank buying and monetary policy shifts. Silver prices held below 38 US dollars per ounce after declining over 1% on hotter than expected US producer price index data, reducing the odds for a large Fed rate cut in September to zero, with markets now pricing in a 25 basis point move at well over 90% probability. Up 30% year to date and slightly outperforming gold's 28% rise, silver benefits from structural supply deficits projected at 206 million ounces this year, up from 167 million in 2024, driven by industrial demand in solar panels, AI, semiconductors, and EVs. 7 years of deficits stem from underinvestment, declining ore grades, and silver's 70% byproduct status in other mining, limiting supply responsiveness despite rising prices. Opportunities abound in mining equities, ETFs, and royalty companies, although we obviously prefer holding the physical silver, with its smaller market size, which is about 1/10 of gold's, amplifying volatility and potential gains, especially as it is undervalued per historical gold-silver ratios. Something interesting to note is silver's dual nature. 50 to 60% industrial and 20 to 25% investment provides stability during downturns, while its historical monetary role over 4,000 years boosts investment appeal amid inflation and currency concerns. Platinum deficits are projected to persist through 2029, fueled by strong physical investment and jewellery demand in China, which captured 64% of global bar and coin demand in 2024, with high gold prices spurring a resurgence in platinum jewellery manufacturing and designs. Emerging applications include platinum catalysts for PVC production and PEM electrolyzers, with 100 gigawatts installed capacity forecast by 2030, alongside China emissions standards in 2026, potentially increasing platinum group metals loadings in vehicles. Second quarter 2025 prices varied regionally from $1,380 per ounce in the US to $2,023 in Canada, showing some volatility amid steady automotive and industrial demand, with the global market expected to grow from 187.38 tonnes in 2024 to 269 tonnes by 2033, at a 3.9% compounded annual growth rate, supported by recycling and clean energy initiatives. The supply crunch has intensified, and dwindling stocks in London and Zurich, disruptions in South Africa, and record Chinese imports of 1.2 million ounces in the second quarter of this year, plus US inflows of nearly 290,000 ounces, driven by tariff fears. China's potential platinum futures trading and its export restrictions on precious metals and market uncertainty, while platinum's catalytic efficiency and EVs and biocompatibility in medical implants make it irreplaceable in zero-emission tech and healthcare, enhancing its sustainability edge. In conclusion, gold maintains a bullish stance through central bank support and hedges against monetary fractures. Silver capitalizes on supply crunches and industrial tailwinds for volatile upside, and platinum rides tightening supply with green innovations, making precious metals essential for diversification in uncertain times. What are your thoughts on how supply deficits could propel silver and platinum, particularly, prices much higher by year end? Let us know in the comments. Thanks for watching, and until next week, good luck in the markets.